So you want to buy a used car lot. Most people think a used car dealer is a salesman with a bad tie and a piece of metal to move. Buy the car at auction for $3,000, wash it, sell it for $5,000, pocket $2,000. One transaction, one profit, goodbye. That's a real business. It's also the least interesting thing happening on the lot, because there's a second kind of dealer. The sign out front says the same thing. Used cars, easy financing, everyone approved. What it sells is not the car. What it sells is a debt, secured by a car it fully intends to take back. The car is a returnable bottle. The store never really sold it to you. It sold you what was inside, kept the deposit, and waited for the bottle to come home. This is the buy here, pay here lot. The questions worth answering are these. Why would a business want its customers to fail? How do you sell the same car 5 times in 1 year? And why is the most valuable machine on the lot not the car, but the little black box wired in behind the dashboard? Start with what it costs to get in. At the top, this is a public company. America's Car Mart, ticker CRMT on the NASDAQ, calls itself one of the largest publicly held auto retailers in the country, focused entirely on what it politely names integrated auto sales and finance. Translation, it sells the car and it is the bank. For the year ending the 30th of April, 2026, it moved 48,891 vehicles and booked $1.28 billion in revenue. Of that, $253.7 million was interest, not markup. Interest. That's the top of the market. You're not buying that today. The middle is a lot with 50 cars on it and a filing cabinet full of contracts. The floor, the real floor, is one man, a gravel lot, a dozen cars, and a dealer license that in most states costs a few $100s and a bond. No banking charter, no Federal Reserve examiner. A community bank that wanted to lend at these rates would need capital requirements, deposit insurance, a compliance department. Your future lot needs a surety bond and a laptop. Of course, you have that. So the question becomes obvious. Why would anyone in their right mind lend money to people? The banks have already rejected people with 500 credit scores, no savings, and a documented history of not paying. The answer is simple. Because you've decided before the car ever leaves the lot that you don't need them to pay in full. You need them to start. Officially, a used car lot makes money in 2 ways. It marks up the car and it charges interest. Unofficially, there's a third it gets to keep the car, and the third is the whole business. More on that in a minute. Start with the markup. The retail industry calls a buyer subprime when their score drops below roughly 620. At a buy here, pay here lot, that's not a segment. That's the customer. Industry figures put around 78% of BHPH lending in the subprime band, with deep subprime borrowers, scores under 580, making up more than half the loans. These are people conventional lenders won't touch, which means there's no competing offer, which means you set the price. The loan is the product, so build it to bleed slowly. Here's how it looks in actual dollars. A car comes off the auction block for $3,000. It goes on the lot at $6,000. The customer puts $1,500 down cash in your pocket before they drive off and finances the rest at a rate that, across the industry, runs around 20% and in many states climbs higher. Consider the documented version. Credit Acceptance Corporation of Southfield, Michigan, one of the largest subprime auto lenders in the country. In January 2023, the CFPB and New York Attorney General Letitia James sued it. Their finding: the contracts advertised a rate of 22.99 or 23.99%, but the actual cost of credit averaged more than 38% and in numerous cases topped 100. More than half of the New York borrowers never finished paying. 44% had the car repossessed. Read that last number again. The lender's own model expected the failure and priced it in. And here's the part people don't talk about. The down payment is not a deposit toward your car. It's the dealer's cash floor. On a $3,000 auction car, a $1,500 down payment returns half the cost of the asset on day one. Collect a few monthly installments, say $1,000 before the borrower goes broke, and the dealer has taken in $2,500 against a car that costs $3,000. The gap left to lose is $500. The car is worth more than that sitting on the lot. So the dealer has almost nothing at risk. The customer has everything. Which brings us to the most valuable object on the lot. Not the car, the box behind the dashboard. It's called a starter interrupt device paired with GPS. In 2014, the New York Times, in a series titled Driven into Debt, reported that roughly 2 million vehicles were already wired with them. Makers like Pastime of Littleton, Colorado, and Imatric, which said it had sold over 800,000 units in the United States. Here's the mechanism, flatly. Make your payment, the dealer texts you a code, the car starts. Miss it, the code expires, the car won't turn over. The GPS then reports exactly where the dead car is parked. Before this box, repossession meant a skip tracer, weeks of hunting, legal risk, a tow truck. After it, repossession is a button and an address. The industry insists the device can't stop a moving car, only prevent the next start. Borrowers told the Nevada legislature otherwise. One reached a confidential settlement. The box didn't change the loan, it changed the odds. It let dealers lend to a 500 credit score with the confidence of a pawnbroker holding the item in the back. Now assemble it. This is the loop. Car in at $3,000. Sold at $6,000. Down payment $1,500. A few payments, another $1,000. Borrower misses. The code expires, the GPS gives the address, the car comes back for a couple $100 in tow fees, debt wiped, keys back in the drawer. The dealer has collected $2,300 in cash and still owns the car. Then it goes back on the pedestal the next morning. Same car, next buyer, fresh $1,500 down. Run that cycle 4 or 5 times a year, and a single $3,000 car throws off north of $10,000 in cash. The bottle came home, you refilled it, you sold the deposit again. None of this is free to run. Repossession has a cost, even when it's a button. Reconditioning between owners, a battery, a windshield, a detail eats margin. You carry insurance, a lot, and a collections staff whose entire job is the phone. And the model has one structural enemy, the borrower who stops paying faster than you can replace him. Look at the aggregate. America's Car-Mart, the public one, reported net charge-offs loans written off as unpayable at 27.6% of its average receivables for the year ending April 2026, up from 25.9% the year before. More than a quarter of the money lent gone. That same filing carried a going concern warning and a net loss of $139 million. The largest, most sophisticated operator in the space nearly lent itself to death. You can't put a loan book on pause. The payments you were counting on either arrive or they don't, which is where the industry keeps meeting the law, flatly, for the record. November 2014, the CFPB brought its first ever action against a buy here, pay here dealer Drive Time of Phoenix, then the largest in the country. The finding, at any given moment, 45% of its installment contracts were delinquent. To chase them, Drive Time ran 290 collectors across 2 call centers plus 80 contractors in Barbados, placing tens of thousands of calls a day. One borrower was called 30 times at work after asking them to stop. The penalty was $8 million. Not a single employee did time. January 2016. A single-lot dealer in Colorado, Herbie's Auto Sales, settled with the CFPB for folding the cost of the very payment reminder device into the loan without disclosing it. The box, quietly, was itself a hidden finance charge. And the money underneath all of it is a market. These loans get bundled into bonds and sold to investors subprime auto asset-backed securities. As of early 2026, the Fitch Ratings Index of subprime borrowers 60 or more days past due hit 6.9%, the highest reading since Fitch began tracking in the early 1990s. Cox Automotive counted roughly 1.73 million vehicles repossessed in 2024, the most since 2009. The failure isn't a defect in the paper. The failure is the paper. So how does an operation this well-armored actually collapse? 2 ways. Inside first. The threat from inside is the one Car-Mart just demonstrated. Push volume too hard, lend to too many people who miss too early, and your charge-offs cross the line where interest income stops covering losses. The kill switch protects the car. It does nothing for the loan. A repossessed $3,000 car does not repay a $6,000 balance. The threat from outside is the money that funds you. Take Tricolor Holdings of Dallas, the 7th largest independent used car chain in the country, built into a $5 billion loan book lending to immigrant buyers, many without a social security number. On the 10th of September, 2025, it filed Chapter 7, Liquidation, Not Reorganization. Federal prosecutors then charged its founder, Daniel Chu, and its chief operating officer with running what the U.S. attorney called a financial crimes enterprise double pledging, roughly $800 million in collateral, the same loans promised to more than one bank at once. J.P. Morgan took a $170 million loss. Fifth Third, around $200 million. Chu, prosecutors say, had $6.25 million in bonuses routed to himself that August as it came apart. The car was collateral you could hold in your hand. The paper written on top of it was not. So here's the verdict, in 2 sentences. A buy here, pay here lot does not sell cars. It originates a loan it never needs repaid, secured by a car it always plans to reclaim, and the customer's cash is the deposit that funds the whole machine before the borrower is quietly removed and replaced. This is not a fringe. By late 2025, BHPH loan balances stood near $32 billion outstanding, and the Federal Reserve pegged the independent dealer slice at roughly 2% of the $1.6 trillion auto loan market and 5% of everything subprime. The buyers of this business are private equity, regional chains, and the bond desks that securitize the receivables. They aren't buying inventory, they're buying a yield. Time to pull it all together and answer the actual question, how much money do you make if you do this right? Let's run the math on 3 realistic versions of your lot. Option 1. Open a brand new franchise dealership. You sink $20 million into a glass showroom, you beg the manufacturer for allocation, and you sell shiny cars at a net margin that, industry-wide, runs around 2 to 3% per vehicle. On a $40,000 car, you clear about $1,000, and only if it sells. Your money buys prestige and a razor. Option 2. Buy a rental fleet. You fight depreciation on every car the moment you title it, you pay commercial insurance that never sleeps, and you pray the tourists show up in the right season. You break even in a good year. You own the asset, and the asset is a melting ice cube. Option 3. Open a buy here, pay here lot. You buy a $3,000 car at auction, wire the box in behind the dash, sell it for $6,000 to a borrower the banks rejected, and take $1,500 down before they leave. You collect until they miss, click the button, tow the car back for $200, wipe the debt, and put the same car on the lot the next morning. Run it 4 or 5 times a year and won $3,000 asset returns over $10,000 in cash, an annualized yield north of 300% on a piece of metal you never stopped owning. Option 1 sells you a car. Option 2 rents you one. Option 3 sells the same car over and over to people it was never going to let keep it. The metal was never the product. It was the bottle.